Welcome back, guys, to another video of Forex Beginner's Guide. This is video 112, and this is about what is a swap. Now, in Forex trading, a swap is the interest paid or received for holding a position overnight. It's essentially the cost or profit association with the difference in interest rates between the two currencies in the pair you're trading. Interest rate. Each currency pair has an associated interest rate set by central bank of that country. Example, the Federal Reserve for USD or European Central Bank for the euro. The swap results from the difference in interest rates between the two currencies in the pair. What is swap in Forex? A swap is also known as an overnight financing charge or rollover fee, and it's applied if you hold a position beyond the trading day. For example, if you're trading gold and you hold a position overnight, the swap will depend on the interest rate difference between gold and US dollar. How does a swap work? When you open a position in a currency pair like gold XAU USD, you're borrowing one currency to buy another. Each currency has its own interest rate, and the swap is the difference between the two rates. Example, if you're buying XAU USD, you're buying gold and selling US dollar. If gold has higher interest rate than US dollar, you may receive a positive swap. If USD has a higher interest rate than gold, you will have to pay a negative swap. That's how swap works. A positive and negative swap. Positive swap. This occurs when the interest rate of the currency pair you're buying is higher than the currency you're selling. In this case, you can receive interest payment from your broker for holding the position overnight. Negative swap. This happens when the currency you're selling has a higher interest rate than the currency you're buying. If this is the case, you will need to pay the broker an interest fee for holding the position overnight. Now, example with positive swap, if you're holding a gold and the interest rate of gold is higher than the US dollar, you might receive a positive swap. And in negative, the example is if you're holding gold and US dollar interest rate is higher than gold, the US dollar is higher than gold, you would pay a negative swap fees. How is swap calculated? The exact calculation of swap depends on several factors, including the interest rate differentiation between the two currencies, the size of the position you hold, the broker policies on swap rates, the currency pair, and the market conditions. The swap is usually calculated based on the contract size and is charged on credited daily, typically around 10 p.m. GMT when New York session closes. Example of swap in gold. If you're buying gold XAU and selling US dollar USD and the interest rate on gold is higher than the US dollar, you might receive a small positive swap each day. If you're selling gold and buying US dollar and the interest rate of US dollar is higher, you might have to pay a negative swap fee daily. The swap amount varies from broker to broker and depends on the currency pair's interest rate differential. For example, positive swap, you could receive anywhere around 50 cents credited per day holding your position. Negative, you might have to pay 50 cents per day for holding your position. Why does swap matters? Number one, long-term position. If you're holding a swing trade or someone who holds positions for extended period, swap rates are important. Positive swaps can add up over time, boosting your profits, while negative can reduce them. Number two, carry trade strategy. Some traders use a carry trade strategy where they borrow a currency with a low interest rate to invest in the currency with a higher interest rate. This allows them to collect positive swaps over time. Number three, cost of holding. If you're not using a carry trade strategy, understanding swap rates help you understand and calculate the cost of holding your position. If the swap is negative, the longer you hold the position, the higher it costs. Swap-free accounts. Some brokers allow swap-free accounts for traders who cannot engage in swap-based transactions, such as those following certain religious practices. With swap-free accounts, brokers charge commission fees or apply different pricing models to account for the cost of overnight position. That was all about swap fees, guys. I hope this all made sense. Make sure you watch other videos and educate yourself on these topics before you start trading. I'll see you guys in the next video.